We are coming off a down week for stocks under pressure from rising Treasury yields. Friday's stronger than expected jobs report sent the 10-year yield to a 14-month high as expectations for further Fed cuts dwindled. For more on how economic data could continue to impact yields, the broader market, and those big tech names, we got Dan Suzuki. He is the Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, it's great to have you on here. How much of a challenge is this bond market going to continue to be for stocks?
Well, I think it's going to come in fits and starts. I mean, I think what we're seeing right now is that the closer you get to pricing out cuts on the way to maybe hikes down the line, and the closer that the 10-year yield gets to 5% and to cycle highs, I think the more the market starts to worry about what the implications of that are for valuations, credit conditions, liquidity, et cetera. And I think that's what you're going to see. I think that we could get a bit of a reprieve here from just the sole focus on rates, because we've been in this sort of earnings vacuum. But obviously, you guys have been talking about this morning. We're about to kick off earnings season. So as you get the earnings season and that comes more into focus, I think you'll see some pretty strong numbers. And I think that the market's focus will be on who are the companies that have the operating leverage that are able to offset any of the negative impacts of that financial leverage that gets hit by higher rates.
Dan, talk to me a little bit more about market sentiment right now. When we talk about what's driving the message, or driving the narrative, the why behind this. When you see yields at the levels that they currently are right now, why is that such a challenge here in the short term?
Well, I think the story that's really been one big driver of the market sentiment and the markets, the strong markets overall, has really been that of liquidity. I mean, we've seen an unprecedented amount of liquidity driven by an unprecedented amount of stimulus over the last few years, and I think that combination has really gotten people on top of the fact that we've been in basically the longest economic expansion ever. There's a lot of positive sentiment and high expectations out there, and I think that's really the liquidity story is the crux of that. And so as you look going forward, higher rates, obviously not good for liquidity. And so I think that's why people are starting to worry about, because higher rates, the more you have to start to worry about valuations, and these valuations are high, and there's a lot of companies out there with extremely high valuations today.
Well, it's interesting because in the notes you sent over, you mentioned the risk of corporate profit stalling, which would, of course, be a challenge for earnings and therefore the broader market. Does that mean you think we are heading towards a bear market similar to what we saw back in 2022?
I think it's possible down the line. I mean, I think that's going to really be a function of how much earnings roll over. I mean, I think you don't want to get too far ahead of yourself, because I think that right now, the story is, sort of act one for this year is that earnings are probably going to be stronger than people expect. But at some point, midway through the year, our expectation is that earnings are going to peak out and stay initially quite strong. And so I wouldn't necessarily worry about the implications of an immediate bear market, but the worse that earnings growth slows down. And again, I don't have that crystal ball. And the more that it looks like we're going to go into a profits recession down the line, maybe in early 2026, the more you have to start to worry about, potential for a bear market, especially if at the same time, the Fed's talking about rate hikes and liquidity is tightening up.
Dan, how real is this talk about the potential for rate hikes?
Listen, I think that, we're all sort of going back to where, the Greenspan era, we're sort of dissecting every word and phrase and sort of, clothes that Jay Powell's wearing. I think that ultimately it's a little bit more simple than that. I think if you want to know what the Fed's going to do, you really just look at growth, because growth is going to drive inflation. Inflation is going to drive the Fed. And at the moment, growth is coming in strong. And if it continues to accelerate, which it may or may not do, the more you see those signs of growth accelerating, I think the more realistic it is that the Fed's going to hike. I mean, we're basically priced out almost all of the cuts for this year. So the next step from a market's perception perspective, whether or not they go through with it, is, another leg of stronger growth is going to be, the driver for market to price in hikes at some point.